Today I want to talk about whether the buy button will be removed once again during the next AMC run-up, or alternatively, whether the AMC squeeze will happen too fast for these market makers to react, causing a number of hedge fund and market maker bankruptcies. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So today I want to start by talking about why the buy button was actually removed. Did these trading platforms remove the buy button for their benefit or for the benefit of the market makers? Did these trading platforms knowingly and willingly take away the buy button for their benefit, or were they forced into it by the market makers, being told their trades wouldn't be routed to the market and being told their trades wouldn't be cleared? So NFA Advisors has put together this thread on the buy button removal. On the 28th of January 2021, there were a number of changes due to ongoing market volatility. Robinhood, Webull and a number of other trading platforms announced that due to ongoing market volatility, the following securities are currently set to position closing only, providing a list of 13 separate securities. During the Robinhood lawsuit phase, Robinhood announced that they were told by the DTCC to post more collateral due to the current ongoing volatility in the market. They said it was their decision to restrict a number of stocks to position closing only, as they didn't have the cash available to post this required DTCC collateral. Robinhood and a number of other brokers made no attempt to collect the collateral required, and they also made no attempt to keep the buy button alive and to not restrict trading. However, it's important to note that Robinhood actually had zero exposure in 4 tickers that they restricted trading on, including CTRM, NAKD, SNDL, and TR. The majority of trades being executed by Robinhood on the 28th of January and the days leading up to the 28th were mostly in AMC and GameStop and a few other stocks like BBBY and NOK. And actually on the 28th of January, Robinhood had zero exposure to those 4 tickers highlighted and therefore had to post zero collateral in relation to these 4 stocks. Therefore, on these 4 stocks, Robinhood had zero need to take away the buy button because they didn't have to post a single penny of collateral in relation to these 4 stocks. However, internalizing market makers, such as Citadel, actually had huge exposure to these exact same 4 stocks, along with all of the others that were restricted. And therefore, even though internalizing market makers like Citadel had to restrict trading on all 13 stocks, Robinhood only really needed to restrict the trading on 10 of these stocks, if not potentially many less. And therefore, it seems like taking away the buy button wasn't actually the responsibility or wasn't actually caused by these trading platforms like Robinhood requiring to post collateral. I believe they were forced into it by these internalizing market makers. If Robinhood didn't take away the buy button on all of these 13 stocks, their internalizing market maker that routes their trade to the stock exchange or that they're selling their order flow to could have simply outright refused to route their trade to the market. Robinhood as a platform would have effectively had to close their doors if they couldn't route any single buy order or any single sell order in any security to the market. That'd be like me asking you to call a local shop or to call a friend, but taking your mobile, taking out the SIM card and taking out the battery and then handing it to you and expecting you to still make that same call. If Robinhood isn't connected to the market via their internalizing market maker, they couldn't route any single trade for any single security, regardless if it was a buy or a sell order. And therefore, Robinhood and these other trading platforms were effectively at the mercy of these internalizing market makers. Now, NFA Advisors also asks and says any guesses out there as to who aided in the buy button removal selection. He's then listed a number of internalizing market makers and a number of different trading platforms that had massive exposure in both AMC and in GameStop. Now, a number of names that will seem very, very familiar are names such as Citadel Securities, G1 Execution Services, Jane Street Capital, Robinhood Securities, obviously, 2 Sigma Securities, UBS, Virtue, and Wolverine Securities as well. Now, you may have also seen this recent article from Frank Nez saying that Bank of America has actually increased their short position in AMC. And guys, if you didn't already know, you can currently get 10 free shares worth up to $25,000 and a free share of Lucid guaranteed on top of that when you sign up to Moomoo right now using the link in the description below. Moomoo and Futu also do not accept payment for order flow. In Moomoo's latest terms and conditions, Moomoo have stated they don't accept payment for order flow, they don't receive payment for said order flow, and they don't benefit whatsoever from selling client order flow or from lending out client stocks. Not only do Moomoo not accept payment for order flow, but Moomoo also don't lend out your securities to other institutions. We know that Bank of America are the prime broker for Citadel Securities, and therefore it may also seem like these market makers are receiving external help or external influence from prime brokers and from major banks. It says Bank of America and JP Morgan continue to bet against AMC despite the repercussions. It says, like hedge funds, banks have also been under much public scrutiny for betting short in the market. Regulators have obviously subpoenaed some of the largest banks and hedge funds after investigating communications between the two parties earlier this year. And it says Bank of America have actually increased their short bets against AMC in May, according to the latest Fintel reports. Now, we know that Archegos use swaps to hide their true exposure in certain stocks, both long exposure and short exposure. It wouldn't surprise me if Citadel is using the exact same tools, the exact same swaps, to hide their true short exposure in AMC. And it wouldn't surprise me if the counterparty or the party lending money to Citadel for these swaps is none other than Bank of America, Citadel's prime broker. Obviously, Citadel heavily leverages their trades with a ratio of 8-to-1. Therefore, they're using 8 times the actual equity they have to invest or to short stocks, or basically for their overall portfolio. Therefore, Citadel has to borrow 7 times their portfolio size in cash from somebody to use as margin collateral or to effectively use as margin. And therefore, it wouldn't surprise me if Bank of America is the bank lending all of this money to Citadel or potentially taking the other side of their trades. Therefore, Bank of America have a vested interest in Citadel's success. And therefore, it doesn't surprise me to also see Bank of America increasing their AMC short positions, basically doing anything they possibly can to help Citadel to stay afloat. Now, you may have also recently seen that a number of different trading platforms, TD Ameritrade, Robinhood, and also I believe Fidelity as well, took away the buy button on RDBX options. William received an email from TD Ameritrade saying thank you for reaching out today. Options trading for RDBX has been restricted to closing transactions only due to their pending merger with Chicken Soup for the Soul. But as Hang Loose says, since when do pending mergers require the buy button to be taken away for options trading? And it's interesting that called options can no longer be opened, but they can only be closed out. Surely if there is a pending merger, both opening and the closing of options should be suspended. Typically in the stock market, when breaking news is about to be announced, the entire market for that stock is halted for half an hour, maybe an hour, or maybe the day before the news is announced. That means both the buying and the selling is restricted, and effectively the entire market is halted pending the announcement. But it also seems weird to restrict the buying and the selling for a potential possible merger that hasn't even yet been confirmed, but even more weird to restrict the buying only. I believe TD Ameritrade and other trading platforms subsequently changed their mind and said that options should have never really been introduced on the stock in the first place. But as True Demon tweeted, he said, if you want to see how brokers, clearinghouses, exchanges, and the SEC protect retail investors, look no further than RDBX's option chain, where the OOC or brokers arbitrarily decided that options were no longer valid and took away the buy button. You can see that for the $10 and above call options, there's thousands and thousands of options in open interest that effectively expired worthless due to the buy button being taken away once again. And as Boss Blunts has said, calls for Redbox or RDBX equaled 539% of the free float. Therefore, TD Ameritrade pulled away the buy button on call contracts because calls cause gamma squeezes. They would have destroyed short hedge funds and brokers and the underlying market makers. Because the calls equaled 539% of the float, if these market makers had to hedge for all of these call options, they would have had to purchase the entire float 5 times over, causing a squeeze and potentially bankrupting the market maker. Therefore, considering the buy button has recently been removed on another stock like RDBX, it wouldn't surprise me if they try to remove the buy button once again when AMC runs up next. However, I think it's also important to think about the number of hedge funds that have already gone bankrupt and the number of hedge funds that will go bankrupt when AMC runs up again. As Stock Savior tweeted, Archegos is gone, Tiger Global is down 50, 60 or even 70% and will be going soon. White Square Capital is gone, Melvin Capital is being liquidated, Anchorage Capital gone, Tyborn, Tiger Legatus, Evergrande, Glacier Capital, Three Arrows, Fantasia, Tiger Asia, Impala, Quant Macro and ADG Capital Management is only a small list of the funds that have recently been liquidated or close their overall fund. And therefore, when the wider market crashes and AMC squeezes, there will be tons more funds that end up being liquidated all at the same time. If a number of these funds that are shorting AMC get liquidated at the same time, AMC will effectively squeeze instantaneously. All of these hedge funds will be forced to buy back their AMC short positions all at the same time, effectively buying out the entire AMC order book. If these hedge funds are liquidated at the same time, AMC will almost instantaneously squeeze from say $13 per share all the way up to say $3,000 per share, or wherever the current sell orders in the current AMC order book actually end. Right now, many of us can set sell orders for AMC at $200 or $300 per share. Some of us using different brokers may be able to set sell orders at $2,000 or $3,000 per share. When these hedge funds all get liquidated at the same time, they'll be forced to buy back hundreds of millions of AMC shares at the same time, effectively buying up every single AMC share that's currently for sale, regardless of the price. And this is why I think these market makers won't have enough time to react when AMC next runs up. When that first wave of liquidations hits, AMC will instantaneously squeeze from whatever price it is currently trading at that time to multiple thousands of dollars per share when the entire order book is wiped out. Obviously, at that point, after the first wave of liquidations, as I've said before on the channel, I do expect a second wave of liquidations and also a third wave of liquidations on top of that effectively escaped the first wave of those liquidations. The second wave of liquidations will be those larger funds that had a higher liquidation point, and the third wave of liquidations will be those funds acting illegally and trying to hide their synthetic shares. I don't think it's possible for these market makers to react before the first wave of hedge funds actually end up being liquidated and AMC is pushed into the multiple thousands of dollars per share position. However, at that point, the market makers may try and step in again instantaneously to restrict the buy button or to restrict the sell button and basically halt all trading to ensure that AMC doesn't run up any higher. At this point, it basically wouldn't surprise me what they try and do to stop the trading for AMC. If anything, I would be surprised to not see them interact in some way or to intervene in some way to try and take away the buy button and potentially even take away the sell button. However, I do think before these market makers end up getting involved, AMC will squeeze during that first wave of liquidations when a number of hedge funds go bankrupt and go under during the coming market crash. As I spoke about in my video earlier, if Credit Suisse do go under, the market will instantaneously drop 5 or 10% in a singular day, causing that first wave of hedge fund liquidations. And when that first wave does hit, AMC will squeeze and it will push AMC into that 4-digit per share region. And at that point, I do expect market makers to try and get involved. Also guys, be sure to let me know what you think down in the comments below. Also be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.